Mutual funds are a fantastic way to take exposure to different asset classes because of their professional management, diversification benefits, and liquidity. However, mutual funds also have a few additional features that are used by savvy investors to help them generate additional return.
The features that we are covering in this video relate to gradual entry and exit from these funds. These features are not available in an autopilot mode in other investment avenues like stocks.
Gradual entry and exit strategies can help investors reduce the impact of market volatility on their investments. This is because the path of the market is upwards, but it is extremely volatile. By slowly entering or exiting a market, an investor can avoid buying at the top or selling at the bottom of a market cycle.
These features are a fantastic tool to get advantage of rupee cost averaging.
So, in rupee cost averaging, we automatically buy more units when the market is available cheap. Most importantly, this feature also helps investors avoid the emotional reactions that can lead to impulsive buying or selling decisions. All asset classes have a period when they are not showing good returns. That's also the time when the asset class generally has the best 2-3 year returns going forward. An investor can also better pre-plan their exits from volatile investments and avoid selling when he is in dire need of funds. We will now cover the strategies of gradual entry and exit from mutual funds in detail. Our focus will be on the situations in which they can be used as well as the benefits they provide. Right from salaried individuals to entrepreneurs, for those whose goals are coming closer to retirees.
These features
are useful for most individuals. Hi, this is Prashant Saraf and you are on my channel Blueprint Investments. I am on a mission to arm investors with the knowledge, strategies, skills and tools to create life-changing wealth for themselves and their family.
These three strategies, SIPs, systematic transfer plans, and systematic withdrawal plans, are commonly used for gradual entry and exit from mutual funds.
The first is Systematic Investment Plan or SIP as it is popularly known as. SIPs allow an investor to invest in a disciplined manner by making the investment at a fixed interval, typically on a given date every month. The second approach to staggered investments is Systematic Transfer Plan. Under this approach, an investor invests money in a safer asset class, for instance, debt, and then transfers the money in a staggered basis into the chosen asset class, say equity. The third approach is the Systematic Withdrawal Plan or SWP. This is the exact reverse of the SIPs and is used to withdraw funds from volatile asset classes like equity on a staggered basis. SIPs are ideal for salaried individuals as they get a fixed salary every month. By investing before they spend, they create discipline in their financial lives. This also helps them to avoid overspending.
SIPs are also a useful avenue to plan for big goals like children's education or retirement.
By investing small sums and increasing the contributions regularly, really big amounts can be saved for these goals over long periods. However, while planning for these goals, you need to remember that if you see negative returns at some stage of your SIP journey, do not panic and continue with your investments. While doing SIPs, you just need to remember to follow the discipline. Discipline helps in managing investor behavior. This is important as it is the main reason investors fail. Systematic transfer plans are very useful to business people and entrepreneurs whose cash flows and incomes can be lumpy and inconsistent. At first, they can choose to invest the lump sum amounts in debt funds, which can provide a steady source of value. Then, they can start a systematic transfer plan from the debt scheme to the equity scheme so that their investments in equity occur in a staggered manner. By following this two-step approach, they will reduce their risks and avoid potential losses. Systematic transfer plans are also a very good way to protect your goals as they come closer. When you invest in volatile assets, it is important to have a plan in place for when to exit these investments. This is especially important when you invest in equity. If you wait till the goal date, you risk losing a significant amount of money. On the other hand, If you exit too quickly, you may miss out on potential gains and risk not reaching the desired corpus. By exiting gradually, on the other hand, you are better able to fine-tune the achievement of your goals. So to sum up, systematic transfer plans are a very effective tool both for entry and exit from growth-oriented and volatile asset classes like equity. ICICI has recently launched a booster STP. This STP allows an investor to enhance his contributions when the markets are cheap. So, whenever you are looking to do asset allocation, you can use this STP to make sure the price is even more favorable. Systematic withdrawal plans are very useful to retired individuals or those who are looking for regular income. If retired individuals put money in fixed deposits, they can initially take care of their expenses. However, every year, things get more expensive due to inflation. So, as the years roll by, they will find that they are unable to take care of all their expenses. By using systematic withdrawal plans from equity funds, these individuals can generate regular income by withdrawing a set percentage on a monthly or yearly basis. Moreover, they will also be able to protect their capital from inflation. By consuming only the growth component of the equity investments, the investor ensures that his investments will grow at the rate of inflation. However, it should be noted that this is not guaranteed, but merely a long-term expectation. Systematic withdrawal plans can be created for either pure equity funds or even for balanced funds. The suggested annual withdrawal is 5% for equity funds and 4% for balanced funds. By withdrawing these amounts, you will ensure that your fund grows at the rate of inflation while you generate a tax-efficient income. To conclude, while you can use SIPs for gradual entry into volatile asset classes, you can use SWPs for the gradual exit from the same asset classes. STPs, meanwhile, can be used for both gradual entry and exit from volatile asset classes.